Iron Financial. This is the channel where we forge stronger portfolios by cutting right through the market weakness. I'm your lead analyst, and today we are putting a giant under the microscope. Ryanair, Europe's biggest airline, just dropped its Q3 report, and frankly, it's raising a massive question for anyone with skin in the game. Is this company the financial fortress it claims to be, an impenetrable castle built on a mountain of low costs? Or are we looking at a carefully constructed facade that's finally starting to show cracks under pressure? We're going to stress test these numbers, and we're going to find out.
And I'm your market skeptic. Listen, everyone knows Ryanair is huge. That's not up for debate. But let's be real. Being the biggest doesn't automatically mean you're the strongest. The headlines coming out of this report are a mess. You've got record traffic on one hand, but collapsing profits on the other. So what is the real story here? Are investors being sold a bill of goods? It's time to put the hype on trial. We're going to have a classic bull versus bear showdown, using Ryanair's own data as the evidence. We're here to figure out if this is a genuine, ironclad opportunity, or if it's just an elaborate investor trap waiting to spring.
All right, here's our blueprint for this analysis. First, we'll establish the sheer, undeniable scale of this operation. Then, I'm going to lay out the bull case, showing you exactly how they're forging dominance across the entire continent. From there, we'll go under the hood and dissect their cost engine, because that's the real source of their power. Then, I'll hand it over to our skeptic to probe for any and all cracks in the bear case. After that, we look at their blueprint for the next decade. And finally, we deliver our verdict. Let's get to work.
Okay, let's dive right in. Before we can even begin to talk about profit margins or balance sheets, you have to wrap your head around the sheer scale we're dealing with here. Ryanair isn't just an airline in Europe. For millions of people, it is the airline. Their market presence is absolutely colossal, a sprawling empire that blankets the entire continent. This scale, this is the foundation upon which everything else is built. You have to understand this first.
You know, the map doesn't lie. That is an impressive footprint. 36 countries, 223 airports. They are literally everywhere. You can't escape them. But here's the thing. A big map doesn't pay the bills. A sprawling empire can be incredibly expensive to maintain, and it can be vulnerable to attack on dozens of different fronts at once. So yeah, being the biggest is one thing, but being the strongest and, more importantly, the most profitable? That's what we're here to figure out. Let's see if the books are as impressive as this map, or if this is all just a case of some very expensive window dressing.
Exactly. And that brings us right to the bull case. The dominance that you see on that map isn't an accident. It's the direct result of a powerful, and I mean meticulously engineered financial strategy. This isn't luck. It's dominance by design. And we're going to start building this case with the most fundamental metric there is, the number of people they actually put on their plane.
Just look at that number for a second. 208 million passengers. That's the forecast for the full fiscal year, and it's up a solid 4%. Now, this isn't just some vanity metric. It is the absolute bedrock of their entire revenue engine. Every single one of those 208 million people is a paying customer. Every one is a potential upsell for ancillary services like priority boarding or seat selection. And every single one is another piece of proof that their high-volume, low-cost model isn't just working, it's a juggernaut. This is the raw power that fuels the entire machine. It's the first and most important pillar in this fortress.
And it's not just about the raw passenger volume. What's so compelling here is that they are firing on all cylinders. This slide right here, this is the steel framework of the bull case. Number one in traffic, we just covered that. But look, they're also number one in on-time performance and reliability, which builds the kind of customer loyalty money can't buy. They're rated the number one large-cap ESG airline in Europe. Now, for those of you tracking capital flows, ESG, environmental, social, and governance, is a huge deal. Big money funds are specifically looking for these kinds of ratings. Their low-cost advantage, which we're going to tear into in just a minute, isn't just stable, it's widening. Their balance sheet is investment grade, rated BBB+, which means the market sees them as a stable, reliable company. They've placed a massive order for 300 new, more efficient MAX 10 aircraft. That right there is their engine for future growth. And most importantly for us as investors, they are delivering top quartile returns. We're talking a 3-year total shareholder return over 150%. This isn't just winning. This is systematic, multi-front domination.
So the billion-dollar question is, how do they do it? How does any company achieve that level of dominance on so many fronts while still offering rock-bottom prices? Well, the answer is forged in their cost structure. This is where we get into the heavy lifting. Market share is one thing, but an unbreachable competitive moat is built on one thing and one thing only, having the lowest costs in the industry. And this, right here, is where Ryanair's true, undeniable power lies.
Now look very closely at this table. This is the heart of the entire bull case.
Ryanair's unit cost per passenger, excluding fuel, is 35 euros. Let's really put that in perspective. Their closest low-cost competitor, Wizz Air, is 77% more expensive at 62 euros. EasyJet is more than double, 157% higher. But then you look at the legacy carriers, the big national flagships. IAG, the owner of British Airways, is nearly 400% higher. Lufthansa, same story. And Air France KLM, it is a staggering 623% more expensive to operate per passenger. And here's the killer detail the market is watching. This gap. It is widening. While their rivals are getting absolutely crushed by inflation, by labor disputes, and by their own bloated legacy costs, Ryanair is pushing its advantage even further. This isn't just a cost advantage, it is an expanding chasm that is becoming physically impossible for competitors to cross.
And this chart just drives the point home perfectly. Forget the percentages for a second and just look at the raw visual here. This is what an unassailable competitive advantage looks like on a slide. For every 35 euros Ryanair has to spend to get a passenger from A to B, Lufthansa spends 171 euros, and Air France KLM spends a whopping 253 euros. So I ask you, how can you possibly compete with that? The answer is, you can't. They can initiate a price war in any market they choose and bleed every single one of their competitors dry without even breaking a sweat. This is financial warfare, and Ryanair has the ultimate weapon.
And the final piece of this bull case is that this incredible operational efficiency is built on a foundation of solid rock, a fortress balance sheet. They have a BB+ credit rating from both Fitch and S&P. They own their fleet of Boeing 737s outright. They are what we call unencumbered, which is an incredibly powerful position to be in. It means they aren't bleeding cash on expensive lease payments every single month like so many of their rivals are forced to do. They finished the quarter with 1 billion euros in net cash. And get this, they are on track to repay their final 1.2 billion euro bond in May of 2026, at which point the company will be essentially debt-free. A debt-free, cash-generating machine with the lowest costs in the industry. That is the very definition of a fortress.
Okay, that's a very compelling story. Fortress, steel framework, solid rock, I get it, you've painted a pretty picture. But a strong frame is absolutely useless if the foundation has cracks. And when you actually dig into the Q3 results, the headline numbers tell a very different, much weaker story. While you were busy admiring the architecture of this so-called fortress, I was on the ground floor looking for weaknesses, and I found them. It's time to stress test these numbers because the report itself raises some very serious red flags. So, let's start with the most important number on any income statement: profit. Last year, in Q3, they made 149 million euros in profit after tax. This year, in the exact same quarter, with more passengers and higher revenue, they made just 30 million. So, I have to ask, how does a so-called fortress with all these unassailable advantages watch its profit simply evaporate into thin air? This isn't a hairline fracture, my friend. This is the first major crack in the foundation, and believe me, it is a big one. Let me just put a finer point on it for everyone. An 80% collapse in profit. Let that sink in for a moment. You can sit here and talk about passenger numbers and cost gaps all day long, but if it doesn't translate to the bottom line, what is the point? How can you call a company a fortress when its profitability can crumble by 80% in a single quarter? That doesn't sound like a fortress to me. That sounds fragile.
That's a fair challenge, but the number needs context. The profit drop is almost entirely due to a one-off exceptional charge. They had to provision 85 million euros for a fine from the Italian Competition Authority, which, as you can see, the company itself calls baseless and is confident will be overturned on appeal. If you strip that out and look at the pre-exceptional profit, it was 115 million euros, a much more modest 22% drop. This is a legal issue, not an operational failure. Hold on a second. A baseless 85 million euro charge that still manages to wipe out most of your quarterly profit? I'm not so sure you can just wave that away. Even if they win the appeal, this points to a much bigger crack in the business model: regulatory risk. As they get bigger and more dominant, they become a bigger target for governments and regulators. This Italian fine might be the first of many. It isn't just a one-off charge, it's a warning shot across the bow.
And it's not the only warning shot being fired. Digging deeper into the report reveals other potential stress fractures. Their cash pile, which you were just praising, shrank significantly, from 4 billion down to 2.4 billion between March and December, thanks to debt repayments and heavy capital expenditures. Their Q3 income was also hit because, unlike last year, they didn't get a nice payout from Boeing as compensation for delivery delays. And let's be crystal clear, the company itself admits that the whole operation is walking a tightrope. It is completely exposed to external shocks they can't control: the ongoing wars in Ukraine and the Middle East, a potential macroeconomic shock, or the next wave of air traffic control strikes that could grind Europe to a halt. You see a solid structure, I see a house of cards sitting in the middle of a hurricane.
You're pointing at the storm clouds. And you're right, they're definitely there. Any airline, any global company faces external risks. But a fortress isn't built for sunny days. It's built to withstand the hurricane. And that is exactly what their 10-year blueprint is all about. The real question isn't whether there's a storm, but whether the structure is built to withstand these pressures over the long term. So let's pivot from the noise of the last 3 months to the signal of the next 10 years. Because Ryanair isn't building for the next quarter, they are executing a blueprint for the next decade.
This right here, this is the blueprint. This is the long-term strategic response to all that short-term uncertainty you just mentioned. The plan is to go from 208 million passengers today to 300 million by fiscal year 2034. That is nearly 50% growth locked in over the next decade. This isn't some vague hope scribbled on the back of a napkin. This is a calculated trajectory based on firm aircraft orders and deep market analysis. This level of planned, predictable growth absolutely dwarfs the short-term concerns about a single quarter's profit dip or some regulatory fine in one country.
And this isn't just a fantasy. They have a clear 5-point plan to forge this growth. First, the delivery of 300 new, larger MAX 10 aircraft by 2034. That's the engine of this entire plan. Second, using those new, more efficient planes to further widen their already massive cost advantage. Third, and this is critical, they are perfectly positioned to capitalize on industry-wide capacity constraints. Their rivals flying Airbus are facing huge engine recall issues, and both major manufacturers are way behind on deliveries. Ryanair has its order book locked in and will be taking delivery of new planes while their competitors are literally grounded. Fourth, just smart financial management, like hedging 80% of their fuel for fiscal year 2027 at just $67 a barrel. That move alone could save them over 500 million euros. And fifth, as we already discussed, becoming completely debt-free in 2026. This isn't a wish list, it's an engineered roadmap to total market domination. And this plane right here is the key to the whole thing. The Boeing 737 MAX 10 is an absolute game-changer for their model. It has 20% more seats than their current game-changer aircraft, but it burns 20% less fuel. Just think about what that does to their unit cost. It pushes it even lower, further widening that chasm between them and every single one of their competitors. It allows them to aggressively grow capacity and market share while simultaneously becoming more efficient and more profitable. This aircraft is the engine that will power their growth and cement their dominance for the next decade. It's that simple.
Okay, so we've laid it all out on the table. We've stress-tested the fortress, we've examined the steel, and we've probed for cracks in the foundation. Now it's time to synthesize both the bull and the bear arguments to deliver our final actionable verdict. Is the current situation a sign of fundamental weakness, or is it a golden buying opportunity disguised by some short-term noise?
The bull case is crystal clear. Their cost leadership isn't just an advantage, it's a weapon, and that weapon is getting sharper every day as the gap widens. They have a concrete, long-term growth plan to 300 million passengers powered by a new, more efficient fleet, and it is all built on a fortress balance sheet that will soon be completely debt-free. But the bear case is just as clear. An 80% drop in quarterly profit, no matter what the reason, is alarming. The fine in Italy signals a very real and growing regulatory risk for an airline of their size and their aggressive nature. And they remain, like all airlines, completely exposed to geopolitical shocks, supply chain issues, and economic downturns that are far, far outside of their control.
So that brings us to the final question. We've seen the strengths and we've seen the vulnerabilities. After putting all of these numbers through the iron financial stress test, what's the verdict? Is this a long-term opportunity to invest in a clear market leader? Or is it a trap where these short-term shocks and hidden risks are about to punish unsuspecting investors?
The verdict is in. The foundation is solid steel. The bear case raises valid points about short-term volatility and external risks. You can't deny them, but those cracks are superficial. The 80% profit drop is explained by a one-off charge. The cash reduction is a direct result of strategic debt repayment and smart investment in future growth. The core operational metrics, the cost advantage, the passenger growth, the forward-looking aircraft orders are not just intact, they are strengthening. For our money, this is a long-term opportunity. This is an airline built not just to weather the storm, but to emerge even stronger on the other side. The foundation is solid steel.